Hi, everyone. Welcome to Trader Talk with Disciplined Mind Trading. If you're joining us for the first time, my name is Bobby.
I'm Steve.
This week, we will be covering distribution days, key to understanding market direction. Let's get started. All right, so we chose this topic. We noticed on Twitter and a lot of other areas that there's a lot of questions and a lot of misunderstanding.
And some of our live chats.
Live chats, yes.
So if you're on this, that's where we got this from, was last week.
Yes. Thank you. So your participation has definitely helped improve our podcast.
Yep.
But there's been some confusion about distribution days, where that lines up in terms of market direction. So we figured this would be the perfect topic to cover this week, especially in the market environment that we are in. So, Steve, take it away.
Yeah, before we even get started, there are a lot of questions about this. Because distribution is one of the key tools to CanSlim and that you can have in your CanSlim arsenal. But it can be one of the more difficult concepts to grasp because it's not black and white, and it takes experience to begin to understand it. So, there's work on it. And because people might think it's black and white, it makes it a lot more confusing for them when they're trying to apply it. And what I've seen through Discord, Twitter, everything else that we're doing, people seem to think that this is black and white, and that's where it gets to be frustrating. And you begin to actually lose faith in the IBD system because you think it's not working, particularly in a market like this that's choppy. So when the suggestion was made to discuss distribution days, I was all over it. I was like, this is a great topic, because if you are a new investor, this can be frustrating. You're like, why is the system not working? Because again, people think systems work at all times. In fact, I'll even go one further. If you watch the Covell podcast, he talks about choppy markets all the time and how some of the greatest trend following traders, which is a little bit different than CanSlim, they get chopped up in these markets, and it's very difficult for them as well. And listen, if you don't realize this, CanSlim is a trend following, technical, but fundamental program. So it's combining a lot of the great tools from a bunch of different areas and combining it. So we just thought this was appropriate, and not, by the way, not to drift too far and get more directed back into the distribution days. So, Bobby, what actually is the distribution day concept?
All right, so distribution day, what is that? So the technical description of a distribution day is a down day of more than 0.2% with volume higher than the previous day's volume. That is the technical description of a distribution day, but there's also a secondary way that we can gain a distribution day, and that is referred to as a stalling day. So what a stalling day is, as per the CanSlim Bible, is a significantly smaller price increase for the day compared with the prior day's much larger price increase. And this is all with, again, heavier volume. So signifying that there's also more distribution in the market, resulting in another distribution day. Now, one of the other things that we need to talk about is how long is the distribution day valid, because they do expire. So the first way...
can I stop you? So
yes.
What we just discussed were the adding of distribution days. Now he's going to go into the subtracting of distribution days.
Correct. So a distribution day is only valid for 25 trading days. After 25 trading days, that distribution day would then expire and then fall off from the count. And then the other way that you can lose the distribution day is by the index moving up. So if the index moves up 5% off of the low of the day that the distribution day occurred, that distribution day would also expire and drop off. So that's the two ways that you can lose distribution days throughout the market. And one other thing I want to note is if you're looking at the CanSlim Bible, How to Make Money in Stocks, 4 to 6 distribution days is a general way to look at when we might go into market correction. As you can see, that does vary, like Steve mentioned before, based on a lot of other things.
So you know what? We could get into some of those things. And it's interesting that you bring that up, because that's where I want to start. So you're saying that distribution days can be from how many days? 4 to 6?
4 to 6 on average.
Okay. So that's on average. I've seen markets where there have been 3 distribution days. I believe last year in February 2020, there were only 3 distribution days, and we went into under pressure, and then we went right into correction. It was that fast. But again, last year was a very unique market. That was probably one of the all-time fastest falling markets ever. So that's one way. I've also seen distribution day and the distribution day count go up to 9 days. And you're like, how on earth? This makes literally no sense. Now, one thing is sometimes it's been, you have like a 9-day count on one market and like a lower count on another market. So there's a lot of different variants here. And again, because we're dealing with multiple markets, it gets more confusing. And I'll give you an example. In the Trader Talk, if you go look at the S&P right now currently on March, wait, a quick wrap, I apologize. On the quick wrap, on March 28th, 2021, that's today, the S&P is about to break into a new high, but the NASDAQ is lagging. So sometimes the markets don't act completely in sync. And this is where distribution days don't do as good of a job. But remember, this is not for you necessarily to buy and sell your stocks. It's for you to be aware of what the market is doing. And then you translate that into what you should be doing moving forward. If you have stocks that are acting strong, I would keep them. If you're considering buys, maybe be a little bit more cautious. So that's where you want to start.
It's like a risk assessment.
Correct. So I want to first say, basically, as I just said, all distribution days aren't created equal. They vary in many different ways, and I'm going to go through the categories and we'll discuss it. By the trend in the market. So since I just gave a good idea of what's going on in the market right now, Bobby, explain exactly what I mean by that.
So when you're looking at the overall trend of what the market is doing, you could start to accumulate distribution, but the market can still be trending in an upward pattern. And that would be an instance like we're occurring now, where even though their distribution day count is going up, the market is clearly still trending up. So the effect, we might be able to accumulate more distribution days.
This S&P is trending up. The NASDAQ is trending sideways.
Correct.
So you hear what we're saying. So this gets interesting. So you get a sideways market. Distribution days are not as valuable. This is what you're seeing right now on the NASDAQ. Mm-hmm. Like, people are getting confused. What do I mean they're not as valuable? Basically, you're not having many stocks break out on the NASDAQ, and it's just churning. So you're going to continually get distribution days. You're going to go into uptrend under pressure, yet the market isn't completely falling apart. So it just gets to be very confusing that way. So that's one way to look at it in a non-trending market. Number two, in a really strong market, distribution days begin to mean a little bit more, because once they begin to pile up, they begin to be that signal. Okay, maybe I should begin to take off margin. Maybe I should begin to take some profits in some of my other positions, in some of my stronger positions or some of my weaker positions. And you got to begin to assess your risk that way, depending on the market. And number three, in a downward trending market, I mean, you should just be getting out, because you know that the market is not going the direction that you want. And it's particularly when they're very severe distribution days. That's
just like last year.
That should be a huge signal to you. So hopefully that clears that part up. Do you have anything else to add on that topic?
No, I think, like you said, it's just one of the things, like you just mentioned, if the market is clearly downtrending, then you don't have to say, well, I don't have enough distribution days. I mean, the distribution is clear in front of you. The market's in a downtrend. Yeah. You don't need the signal of the distribution day as much.
Yeah, and at the end of this video, we're gonna really tell you exactly what to consider for your individual stocks, because believe it or not, there are times you shouldn't even sell. And we can get into some of that things. All right, the next thing is severity of the distribution day. So this week we had distribution days, right?
Yes.
But they weren't really particularly severe, if I'm remembering correctly.
There was maybe one day on the NASDAQ that was a little bit more severe, higher volume, and bigger down day.
But okay, so when you have like about 0.5% distribution day, and there's higher volume, usually that's not
the weight of that.
The weight of that is not as significant as you get a 3 or 4% massive volume day. They absolutely are different, and that's what you have to consider. And even in and above that, you have to consider where the market is. So you can get that bigger distribution day when the market's trending higher. In fact, last year we had a couple of doozy distribution days, but the market then went right back into an uptrend. Like it just. So sometimes you have to really analyze a distribution day, not just only on that day, but in the days that are following it to see exactly what's going on. So like I'm telling you, this is not black and white. And that's where the more experience, the more you delve into this, it begins to make more sense.
Absolutely. Yeah. It's the whole picture, not just the number of distribution days or the distribution day itself. It's the bigger picture of it, which is why they refer to it as the big.
Right. And then you also get clustering. That's the next topic. So if you get a bunch of distribution days, lighter distribution days, and they're starting to cluster, you should absolutely take heed on that. In fact, any distribution day, you got to begin to really look and analyze what's going on. So when you get clustering, that's beginning to tell you that someone's selling some sort of stock. And that you've got to be aware that there's definitely beginning to be the footprints of institutional selling. So that is really important to consider. And it depends on what the market is doing at those times.
And that's, you just made a perfect point of just institutional selling. That we probably should have stated this in the beginning. Like, the goal is for this is seeing where the institutions are starting to offload shares, because as an institution that is holding very, very huge lots in these stocks and in the market, it's going to take multiple days for them to be able to sell off their shares without hurting themselves in the selling process. So this whole process is trying to understand what are these big institutions doing as a just overall view, and knowing that we want to be on the side that the institutions are on, because as most of us know, it's 3 out of 4 stocks are going to follow the overall market. And we also don't want to fight the institutional money because they're going to move the market, not us.
Right. And yeah, so that makes a lot of sense. And one other thing I did want to say is that distribution is harder to see than a follow-through day, because
100%.
you have to act faster when you're going to get that severe downturn. And that's why people get frustrated, because they want to sell quickly into it when sometimes you might not necessarily have to. So that's a really key point why this is so much more important, because this is what protects your portfolio. Where on a follow-through day, usually if it fails, you're not putting a lot of money in it because you're not seeing the true market reacting the way that it should. So that's important to think about as well. So the next one is the severity of the clustering. So like we had said before, last year in February 2020, you saw I know the most severe clustering that you've ever seen. If you have access to MarketSmith, just study that. That's going to be a textbook in how quickly the market can fall sometimes. But believe it or not, I've seen other markets fall, not that much, but I've seen markets fall that quickly. And that's why understanding distribution is so important, that the severity of it. But sometimes you get light clustering of distribution days. That then is different than the severe clustering. And I know this is sad. You're like, there should be no difference, but there is. And you could see it just by the trend of the market. Is the market still above its moving averages? What are the levels in it? And I'm combining actually 2 right now. But they're so important. They're tied together so much that the certain moving averages and the certain levels that are in the market technically begin to assign a higher value than if you're just getting clustering and the market's not moving through any moving averages or through any severe or important buy sell points.
Yeah, it's like you're
levels.
thinking about the degree of the drop, the amount of distribution in a shorter term period, and the severity of the volume, because sometimes you'll have like just slighter volume, it still qualifies as a distribution day. So it's like comparing all 3 of those things, like how big's the drop, how many distribution days in the short-term period, how bad's the volume. All 3 of those things are going to create really the market direction and how big those distribution days may be, which is going to vary on why sometimes the 3 distribution days will cause a correction, and then sometimes you may go up to, like Steve said, 8 or 9.
Yeah, and also, are you breaking through those key levels in the market? That's so important too. And they all these things are combined together. And this is why I keep saying it's with experience. It's with experience that you begin to learn and understand all of these valuable points.
Yeah.
So the next thing,
by experience, it's a time thing. It really is.
Yeah. I don't know one IBD investor who's not lost faith in this system, because it gets it gets confusing. Now when I'm doing this, I understand I have to just be more present and just know what's going to happen next. Excuse me, on these days and in the market. So that to me is the most important thing.
Yeah, absolutely.
So, yep. So the next thing is the key to this concept is to understand that the trend is changing and that when you get many distribution days, you should keep an eye on your stocks that are underperforming. So what am I saying by that? Basically, you have to understand everything that we've just discussed about where the distribution days are. But then at the same time, once you get this clustering, or if you get a severe distribution day, you got to then pivot back to your portfolio to see exactly how these distribution days are affecting this. Earlier, I said you should be looking. There have been times where I've had stocks that have been such big market leaders, and I'll give you an example, like Apple back in the day. This stock didn't even budge when there were corrections because it was such a powerful market leader. So at those times, you didn't have to really take any action if you don't want to, because the stock was telling you what it's doing. Other times, you don't even get distribution days, and you got to pay attention to certain stocks that are breaking down. So how are your stocks, and is your portfolio reacting to these distribution days, and what's going on? That is so important. And that's what distribution days begin to affect how you're managing your portfolio. What do you think?
Yeah. Well, I know we're going to say this towards the end, but I figured this is probably even better point. Not more better. This is a better point to mention this. Is weakness in stocks is more important than the overall market. If you have weakness in your stocks, you can't ignore that because we're in an uptrend. That's just one thing. That's another point to just be made.
Yep. Next point. So as we're saying, this is very confusing, could be difficult to grasp. You have a place to go to and to look for and to look at and to access. If this is confusing, if you're not sure, if you're unsure, why are they doing this? Is actually all the videos that IBD puts out, but specifically the big picture. The big picture is going to tell you what and why they're thinking and what they're doing. In fact, a couple of weeks back where this topic began to show itself is, I believe there was in Discord, was it a distribution day, or did we go to 7 or 8 distribution days and people were wondering why I know exactly what it was. I'll tell you exactly what it was. The market went from market and correction to uptrend resumes without a follow-through day. Correct. And people were completely confused and wondering why. And this is where experience begins to come into play. I had seen it before. So this wasn't the first time I had seen that. And I wasn't surprised at all, whereas other people were completely shocked and aghast. So there are things that IBD is listen, they wrote the system. They know it better than you. Don't fight what they're doing. If your portfolio is telling you something else, do what you have to do to take action, but don't fight what they're doing and telling you, because again, they know better than you. They know better than me. They know better than Campos. They're the people who write the paper and have the experience. So that's so vitally important to refer back to the big picture to get that. And there are other places. I mean, like I said, there are other references and resources, Twitter, our Discord channel, just multiple places you can go. Arusha's podcast that might be accessed. They might put out a video. There's just a million different places you can get this information to help you understand and clarify exactly what's going on with the distribution days. Anything to add?
No, it's a process of interpretation. What it comes down to, it's not this is a set in stone, like Steve said before, black and white way to approach things. There's so many factors that play into the overall market direction, and you really should just look at distribution as a huge tool to understand that, but understand that it is not the only tool that will help you understand which way the market direction is going. So there's a huge weight put in distribution, but there are also other factors that are going to play into that, which are going to help you interpret. And then from all of the information, that is where you get the final thing, which is uptrend, under pressure, correction. And that's just the result of all of this information.
Yep. I'm not going to, I want to make sure that people understand this. In the 90s and 2000s, when I started trading, I'll admit that this was a little bit clearer, but where this gets clearer, and it may be because the market's traded a little bit differently there, but the interesting point to me, and this is probably the most important point I could really sink in to people, these work when you need them to work. And that's the key, that when you're getting that shift in the market, they're going to work beautifully. When you get a follow through, it's going to work beautifully. In choppier markets, there are very few tools that work well. And that's what we're experiencing right now. And that's why people are getting confused. In the 90s and 2000s, if there was a choppy market, these didn't work that well either. And people would get frustrated and annoyed. And just thank the Lord that there's social media that you could refer and find videos like this, that if you're confused and don't understand it, that you can now realize that this isn't a new phenomenon. This has happened in the system. They might not go into it, but they figured that people would understand that. But clearly people don't. And this is a topic for conversation and why we made the video.
Yeah. Look, the goal is this. The goal is to get in on these bigger uptrends. Not saying you're getting in at the bottom, but to get into those market on the bigger uptrends at an appropriate time that is going to allow you to ride an uptrend like we did last year. Perfect example, the follow through day came in. A lot of people felt like there's no way this market's going to go up. Signal came in. If you were a disciplined cancel investor, you said, I'm going to start slowly putting some money to work. It pulled you into the market and you made a lot of money out of that. And the same way where last year, when the market really quickly correct, it got you out. The 2008, 2009 whole market crash that kind of happened, it got you out of that market. The .com bubble burst, it got you out of that market. So the goal is
87 crash. It gets you out of all the big.
It's going to get you out of all the bad crashes, and it's going to get you into all the big uptrends. And there is going to be times, and let's face it, if the market's choppy, it's just that the direction of the market isn't very clear. So therefore, nobody is really going to truly know which way this market is going. And that's where you're going to get a lot of mixed signals, because that's what the market is doing. So it's just understanding the purpose of why this tool is so great and applying it to your trading strategy properly.
It's interesting what you just said about choppy markets, because, and we've mentioned it a couple of times, that most tools don't work in choppy markets. But what's interesting, what's going on right now on March 28th, 2021, we're having massive sector rotation. So someone said this within the past month, that we're in a bear market for growth stocks. I think it may even be Eve Bovich on the IBD podcast. I'm not sure. I believe it was her.
You might be right.
It could have been her, but whatever. Someone said it. If it's her, I give her credit, but it wasn't me. I can tell you that. But I read it, and I was like, whoever wrote this is 100% correct. Growth stocks are in a little bit of a bear market right now, but it's only natural that this happens. And you're having banks doing well, oil companies. If you watched
Quick Wrap?
Yes, Quick Wrap. But I don't know why I always get
That's
that
right.
wrong.
I mess up the after hours ramble all the time.
Yeah, there you go. So the Quick Wrap, if you watched our quick wrap this week, we talked about banks and oil stocks that have very high rankings on the industry rankings. It's just different than it was 6 months ago, where you had auto stocks and you had software stocks and you had internet stocks. It's just not there right now. Eventually, there's gonna be another time where those stocks take the lead. It's just not right now, and you just have to act accordingly and just be aware of that. And it is what it is, and just don't be too aggressive when you get into a choppy market, and just take smaller positions and act appropriately. That's it, and that's what these the high distribution is telling you, and how to act and respond to this. So really, ultimately, to wrap this up, what are we saying? You get distribution, but what's the purpose of distribution? It's how it relates to your portfolio and how you're about to put on trades and consider what's going on in the market. And that's all distribution is supposed to do, is begin to give you that stimulus on how you should be responding and reacting within your portfolio. That is the ultimate key, is to make you aware of the stages of where you are in an uptrend. So again, we probably didn't get into this, but we do it on the Quick Wrap. We do it with the pizza review, what our scores are, things like that, believe it or not. When you have like 1 or 2 distribution days, you have lighter distribution. and that you could act a little bit more aggressively. When you get 3 or 4 and you're not in a uptrend under pressure or anything like that, maybe you take a little bit less risk. But the market gives you those cues and signals. The more experience you get, the easier it is to understand. And lastly, it's all how it relates back to your portfolio. Ultimately, your stocks and how they're performing override whatever is happening in the market. And if your stocks are acting strong and the market's acting weak, just make sure you keep an eye on your stocks, that if they begin to roll over, that you take the right action. If you have stocks, the market's acting strong and your stocks are acting weak, then you got to take the appropriate action because maybe their industry group is doing poorly. So all of this is all interrelated. It begins to make more sense the more you do it. This is a complicated, difficult system. We wouldn't have a podcast. We wouldn't be doing this if it was completely easy and you'd be able to learn within a week or two or a month or two. It takes a long time and is complicated. That's it. What do you have to add?
Last thing I have to say, and you kind of noted, kind of hit on this before, is like just understand, especially for the newer trader investor, you don't have a full understanding and grasp of the system overall. And if IBD is saying something, it is because they created the system, they understand all the nuances of it, and just know to yourself, all right, I'm probably missing something. And it just means that I have to take the time to just do a little bit more work and figure out, what am I missing? What are they seeing that I'm not seeing? And more often than not, you'll say, now I see why they're doing it, because of, and whatever the reason is. And just, it takes time. It takes multiple years and multiple markets to understand what is going on, because every market's going to be different. And you may be put in a situation, this may be the first choppy market that you have ever seen if you haven't been investing that long. And until you experience it, until you see how things can work out and how they pan out, it can be very confusing. So just put the time in, be patient, and you'll see after some years of learning, it'll all start to make much more sense. That's all I got to say.
That's all I got.
All right. Well, we hope this was informative for everybody. If there's further questions, comment below. If there's something that you think other people need to hear that we missed, comment below. If you want to do it in a more of a one-on-one type of fashion, there's our email, Instagram, both of our Twitters. And this is probably one of the greatest places to discuss this is our Discord. There's a lot of people of all levels in that Discord. And this has been a topic that's been discussed throughout this, past couple of months in this market. So in the description, there is an invite link. You click on that. You can join. And if you don't have an account yet, it'll prompt you to create one. But yeah, that's another great resource to just kind of get an idea of what's going on in the market. But that's really all I got. Appreciate everybody joining us. Steve, what do you got?
Endure the pain. Discipline.
Stay disciplined.